Welcome to the second session of the 4-week and the final session tonight. I'll tell you up front, I appreciate people who've hung in there. As we go through it, you see a note under chat there about the road trip to the tour of the Chicago Mercantile Exchange Group. If you haven't, it's not too late to contact Dennis, but it does look like they're going to proceed with putting that together, and he'll follow more details. Last time we did lots and lots of calculations. This time I'm going to have the calculations done towards the end, and we're going to talk about how we might, kind of put this thing together. We've gone through and we've talked about the futures and the basis. We've talked what they are. We've talked a lot about what they tell us, and we're going to look about what they tell us today. Should I store? Shouldn't I store? Should I be in the futures? Shouldn't I be in the futures? We've done lots of mechanics the last couple sessions, just technically, mechanically, how do these various pricing tools work? And then we've looked at when the futures and basis tell us which pricing tool to use, and we've talked a good deal about that. So tonight we're going to try and put it, actually I should have had this one here. I'm going to go through a short management marketing plan, some thoughts. I'm not going to do a whole full-blown one. I am going to put a longer one under the readings. I'll say it again at the end, but just for you that are interested, I'm going to leave this material up on my web page. The links will be there for several years, and then we're going to figure out a way to save them just in case, not that you'll want it. So the book will be there. The book will be there. If you have other friends that want to go through it, feel welcome. They can have, print off the notes and go through those on their own. When we go through this little bit of the things I'm looking for, I really picked out the ones that I'm going to tie into it as I go through here. So I'm going to first go through corn. I'm going to look at some fundamentals, otherwise supply and demand, some technicals. We're going to talk some about whether we think the futures are going up and the odds. Should we store or not for each of corn and soybeans? Which tools should we be using right now? Which one shouldn't we be using? And then, we're going to talk some about this. This part here is really in this bottom part. And one thing we want to remember is we want to learn not to repeat errors. So as we motor on through, we're going to do this pricing plan here. Oops. Where'd it go? Come on here. Anyway, this is where I want to be. The time frame for marketing, you can mark it up to, after harvest if you want. I generally, the studies have shown it usually doesn't pay to store it through a harvest. Way back when, in the mid-'80s, some of you might go back where the government was paying you to do it. But we can price crops in 14, 15, and 16, and you could probably get a bit out further than that. I think you ought to take a horizon of at least 18 months, 30 months preferably. Basically, I think you need to start looking at things about 2 years before you plan on harvesting that crop, and for 6 to 10 months after that. The part after that's mostly what the market tells you. The first 18 months before that, or 2 years, really has more to do with, do I think it's a good price or don't I? So we're looking at, several years. There's key questions you need to ask. How much risk are you willing to bear? And we don't have time, but my desire when I really look at marketing plans and stuff, that first we go through a person's net worth and equity. Otherwise, what's your balance sheet say? What's your income statement say? What's your cash flow statement say? That really should have a lot to do with your marketing plan. Just how much risk can I take? can I lock up enough right now that I don't have to worry about my net worth going down, or I don't have to worry about it going down more than 5 or 10%. We're in farming. We know our net worth jumps around some. You also need to be in a comfort zone. You know, the first one up here is your ability to take risk, and this is more what I call your willingness to take risk. You know, how much risk are you willing to capitalize on to get potential opportunities? And when we look at where we are today, we're actually going to look at those odds. What are the odds about prices going down or prices going up? You know, when you don't price something, you're really using your equity to take care of your risk, versus something like a hedge or a forward contract, or if you've sold that or priced that product. That's okay. We just need to recognize when we're doing it and be sure that's what we want to be doing at the time. You need to think about your goals. We need a dollar number here on this financial exposure you're willing to assume. And then we need to know some things, and we'll give you a couple forms to look at those. What's your most likely number of bushels you're going to get? What are the yield and product risks that you might get? You know, what's my odds of getting 50% of a yield? Actually, if you all think it through, we've done some studies, and farmers are actually pretty good at this. Just looking back over it, every once in a while they get a little too hung up on the near term, but if you get them thinking over a long period of time, and they think back, or you think back, you know, you kind of know, okay, there's probably only, and I have a lot of deep, rich dirt, there's probably only a 15% chance or a 5% chance of me getting half a crop. I'm in sand. There might be a 30% chance of me getting half a crop. And then we're not going to talk about it, but there's always crop insurance here that sometimes can backstop harvest plans. So that can take care of risk, and it can go together. So we want to look at planned acres. Okay, how many acres you're going to plant? Your yield probability charts, which I just talked about. So, you know, if you think you're going to have 150, is it 150 times 1,000 acres, to 100 acres, 400 acres? There's other types of risk, prevented planting risk, harvest quality risk. You know, we generally only think about this yield risk, but there's quality risk at times that are the same thing. What's our odds of getting some discount that we weren't counting on? This is a chart I stole from Roger Betts, an extension educator, and you see it was done a couple years ago. Sometimes people are surprised how they did. You know, how much did you get from the corn crop in 2008? Of course, we don't want to talk about 4, 5, and 6, of course. What was your total production? Okay? When you took that total production and divided it into dollars, what was your weighted average price? You know, what was your average price? What was your planted acres? What was your actual yield? I like to look at trend yield, but in any one point in time, you know, taking Olympic average, unless you have real bad, where you drop the high and low and stuff, you can get a pretty good idea of what your yield might be. And then put those numbers down. This was an actual farm. It obviously wasn't a real big farm at this point. You know, I think my average yield for the last 5 years, dropping the high and low, is 138 bushels an acre on 200 acres. If I get this 138 here times 200, I have 27,000. I have over 5.5 contracts I can trade. But if I get half a crop, I have 2.5 contracts I can trade at 5,000 bushels each. So it's pretty important. Now, when we say 50%, this is 50% of the crop, this isn't a 50% chance of that happening. My guess is, there's 50% chance you're going to have, 85% or better. Okay, can we get a better yield than 138? Yes, but that doesn't get in the way of our marketing plan. We're not going to market over 100% of our bushels. In fact, we're probably not even going to market near that many. Let's structure our plan. You need a, when I think of a marketing plan, I think of two things, okay? And I'm down here for a second. I think of the bushels to sell and how much am I going to sell in each period. And then the prices I'd like to sell them at. And I'm going to talk about that a little bit here on some of this new crop pricing when we go through. I may or may not reach my target, but by May I might want 20 or 25% of my crop priced, if they're reasonable prices at all. We need to be probably doing some pricing before March 15th, and now we're getting awful close to that. If you haven't, I'm going to give you an opportunity to think about it. But this is, for 2 years prior to this, okay? If you had thought there was a real good price a couple years ago and you priced at 25% that you want priced by March 15th, you're done. Unless it hits some high target. Late spring, early summer, that's the sort of end of planting time. And then we have to make decisions in harvest and in January, March, and be done with it in a July type period. These aren't locked in stone. It's just to get a thought process through. There's two ways we need to be thinking. How much we want to sell during a period and the target price or target prices you might want to. Things can change. Situations change. As you go through the season, you know more and more about your yield. The fundamentals out there change. So we might have targets, how much we're going to sell, and at what price. Let's think about what might make that change. Did something happen in the world that makes it change? There's some things happening right now that made prices jump we didn't expect. So do we take advantage of those? Do we price a little bit more early? Those type of things. So have these targets down and then think more about what you might do. The degree of volatility, that's the risk you're in. Okay? I'm going to show you some charts that we still have a lot of risk going out to July and next harvest. But the volatility isn't near what it was a year ago. That doesn't mean it can't pick back up, but given the, especially in corn, given the large projected ending stocks, and it'd be hard to tear that down a lot unless all of a sudden we need that corn for next year. So in that sense, there's not excess ending stocks. Are there patterns? Is there a place where new crop tends to be the highest? There's some studies that the market pays a risk premium sometimes up until about May. Seems to go away by the 1st of July. Old crop, is there seasonality? Over a long period of time, there tends to be. On average, the prices tend to go up during the year. And if people weren't expecting that, then people wouldn't store. So there is some seasonality as we go through a year. I always like this one. If you think you can outguess the commodity markets, you're nuts. Okay? Now, that's what makes it so hard in farming. We can't outguess the market, and what we mean by that, we can't be sure it's going up or sure it's going down. We can't even be very sure, hardly sure it's going up or hardly sure it's going down, although it's going to move. Although once you get excess ending stocks, it tends to move less. So we got to work in that market. Yet, on the other hand, we do have to decide when we're going to sell. And if you say, I'm going to sell, in essence, you're saying, I don't think the market's going up anymore. Or I'm not going to sell. And in essence, you're saying the market's going to keep going up. If you could outguess the market, why bother to grow it? Because you can make a lot more money the way you'll see on this trip that you may go on. I'm not going to spend much time on this, but I say the market's efficient most of the time. So I don't try and beat it. On the other hand, my pricing goal is going to be more risk control, risk management than trying to beat the market. Because you can't. Now, every once in a while, okay, see, I don't believe this one where you can always beat the market. Every once in a while, there's a big shock to the market. The market overreacts. You're never sure that it's overreacted, but there's times where it shoots up, that last little bit there. When that's true, sometimes there's a chance to take advantage, but we can't plan on that regularly. Ned has a neat comment down there that goes back a little bit. If you're not really sure what it is on your farm, there are county averages. So if you have kind of average land in there, or you know it's a little less than average for your county or a little more, you can get an idea of what the yields are. Thanks, Ned. Cost of production. I think it's important because it starts, especially the cost of production per acre. I need to know how much money I need to make to cover different costs. We'll start down here with cash flow. The biggest one, I need to know, I'm going to spend so much money this year, I don't have any choice. So much money is going to leave my bank account, whether it comes out of money I have available or where it comes out of my equity. I have to sell something to get it. So there's cash flow requirements. What's that cost as I go through the year, given the number of bushels I have to sell? Maintain net worth. That's kind of how an accountant would call cost of production. If I got this price, my net worth would be the same next year after my spending and other stuff. Total economics cost over time. This is the one we want to get. This is the one that pays you more for your management, pays you more for your investments on your land and your equipment at values that they're worth now. So this is our goal. This is the one that kind of has to be. I kind of like to keep an eye on this one in the sense, because over time I teach a farm management class as well. What's my goal? I want to grow my net worth. Okay, that's one of my main goals. Now, I want to enjoy doing it. There's other reasons you're in farming, but in a business you're trying to grow your net worth. So I always want to have conscious. If I price this much, can I make sure I can't lose more than 5% of it this year? Maybe I'll make a lot more. Again, how much equity you have in there. The only way you know that is if you have a balance sheet, if you have an income statement. Let those, instead of you just saying, I like to gamble, let your financial statements tell you whether you can gamble or whether you can't gamble. These costs aren't right, and I'm going to put up some that are other, but we have to be careful here. There's different debt farms are going to have different types. First of all, each individual is going to have a little bit different cost, but also high debt or low debt farms could have a difference. But just as something to work with, and I'm going to show you in a minute where I got this. This is Roger Betts, but Dennis Stein has good numbers to work with, and they're both in spreadsheets, so you can fix them with your own numbers. Total economics cost on a particular farm, and I don't have the yields and stuff. I think it's about 150, about 511. Maintain net worth about that 450 level. To me, cash flows is almost as high. And then we have them for soybeans over here. It's imperative that you know yours. There is a method to find those out. My web page, is right here. It's part of this firm web page. I suggest you go visit the whole web page. I think you can get a lot out of it. If you come up here, the budgets, cost, and decision-making tools, they go through that. That's where I went and grabbed these numbers I'm showing you right now. Don't just, they have good starting points. They're in spreadsheets. Put in your own cost. Put in your own cost of fertilizer. Put in your own yields. Put in your own equipment cost. what's neat is there's formats here to help you do it. I just stuck it down here, Dennis Stein. If you hit that, this is what shows up at the top of the page, and then they have all kinds, custom work, crops, fruits and vegetables, livestock, business analysis handbooks. These can help you do the financial work. They also sometimes can compare it to other people. Dennis has estimated crop budgets, which you can look at and then adjust to be your own. This is a critical part of marketing. It's a critical part of farming. Does the market care what your costs are? And I would argue yes or no. The question is yes or no, and my answer is yes and no. Right now, for your 2013 crop, the market doesn't care what your costs were. There's so much people are willing to pay for the amount on the market right now, and if that number changes, I know, as you see prices changing every day. Now, over time, the market will break even, not at any. And this becomes more important here. The market does care about new crop because they know, because if it's not high enough, people won't plant. And then it is corn versus soybeans. It's the returns per acre for which one. Okay, if you want more soybeans, you got to bid that price up so people have higher returns per acre for soybeans, and they can make some marginal shifts. And this, in the opposite way for if the returns per acre were higher for corn. The market's doing this right now. How many acres of corn do we need planted next year versus how many acres? And that, I forgot to put that slide in, but we're going to talk about it anyhow. You need to look at historical patterns to assess both the current price. I mean, sometimes you look at history and say, you know what, this is just a good price and I'm going to take some of it. Has it been higher? Yes, but it's good. It's higher than my full economic cost. I'm going to take some. We're going to look at supply and demand balance sheets and what futures are today and what the situation is. We're going to look at using options, but I'm really using options in two ways. We may use them as a pricing tool, but options are insurance. They tell me how much volatility is in the market. So when I show you those probability distributions, I'll remind you that the only way I can come up with them is because the option market, people are bidding on the price they're willing to pay for the risk out there. The use of charts, especially for setting short-term and daily price targets. As we'll talk about, you don't fight a trend. You know, if the market's going up, you let it ride. You may price some into that, but you let it ride. The hard part is then you need to know when it's stopped going that you need to price some. You need to think of near term. Do I need to do something now? You need to think of the longer term. The near term here, the price potential is kind of what's it going to be here? Well, I'm going to keep storing this stuff, today's crops. Maybe I did a basis contract on soybeans last fall. When do I need to get out of that if I haven't? Or, as I'll talk about, maybe I got out in the fall and I want to get in right now. Longer term, what do I plant this spring? I know that's not very long away, but the price is this year and the next year. The longer term also makes you think about the mix of crops you have, what kind of rotation you have. You know, any one year, maybe I'm going to plant a lot more corn or soybeans, but does that work in the long term, either for prices or my yields? My apologies for this, but this is something that I'm going to talk about when I look at the charts, and this is something that happens to everybody. This isn't just farming, and it's called anchoring. We get way too hung up on what's just happened. Either we had a really bad yield, so I'm afraid to price any because I won't get any more. We had really high prices, Prices are still good, but they're not as high as they were, so I don't do anything. I saw this happen. It happened real bad in 95, 96. If we'd pre-priced a lot of our 97 and 98 crops, instead of waiting, we would have been way better off. But no, we just seen $5, so $3 wasn't very good. Well, what did they turn out to be? $2.50, then $2.30 or $2.25. So this is something that everyone tends to do. The only way you can really beat it is understanding that you might be doing it. Okay, and then as I talked about earlier, you look at the odds, probability distributions. You look at prices over, that's this one here. You talk to a lot of other information sources. You think, can this price go lower? You know, what's influencing why I think prices will do what they do? You know, if this $7 we saw last year isn't going to happen, I better think about it. And we probably didn't think about it enough. The other thing that happens to people, they'll get caught up into something and they won't get out of it. This is a long story here. People had a chance to get out of some poor positions, but it has to get better, it has to get better, and it didn't. And that particular time was a spread between July 96 and December 96 futures. Rolling basis contracts. Why do I do a basis contract? Because I think futures are going to go up. Well, I'm going to use a May futures, so a basis contract I have to make a decision on by the 1st of May. Oops, prices didn't go up, so I want to roll it to July. Oops, prices didn't go up, so I want to roll it to August. We get a whole lot, too much invested to quit. We do it sometimes storing grain. My wife had an uncle that I found this was back in the mid-70s, I go back away, where I had to chop those soybeans out that had seen $8 and $12 and $9, and then they didn't see any dollars. What can you do about it? Bring other people into the decision. Don't go saying, I'm going to do this no matter what. This is the last one down here. And I'm not going to read all through this. I'm going to put these notes up for people to look at it at more their leisure. But between the escalation, especially that anchoring, I think it's really important. Sometimes we get too hung up, you know, in 96 on it, oh my gosh, I got to price it all when it hits $3 because it only has been that way 3 times in the last 25 years. For each period, okay, I want to price some by May, or I want to price a certain amount before I plant. That's the time trigger. Price trigger. We'll look at what might be some price triggers today. I will price some at $4.75 July futures. Is scaling up warranted? Since it's hard to predict, do I price, you know, 500 bushels at $4.50, another 500 at $4.60, another 500 at $4.70, or maybe 25 cents in between? You know, would I change that if there's a really fast, steep upgrade? You have to continuously be reassessing opportunities, but that doesn't mean you drop your plan all the way and you have to say, uh-oh, is there more risk? Do I have to change things on account of I can't afford that risk or I don't want to? Sometimes we're looking, are you going to have to restructure debt given price prospects? Maybe I had a lot of near-term debt because the price were good enough. I wanted to pay it off as quick as I could. That's not bad. But at times, sometimes that doesn't work, and some of that short-term debt or intermediate debt may have to be turned into it. Be realistic. Will the prices get back where I don't have to? Who's responsible? Not me. You are. So as we look at this here, write things down. Have a person you trust look at your plan, and ask these people, be honestly realistic. Does this make sense? Is there a chance this might work? Look at it. Don't just write it, and then stick with it. Remember, part of your plan is planned adjustments. These are the things that can happen, and if they do, this is what I might do. The market jumps up 30 cents in a day. Maybe I was going to price 2 bunches, but I only price once because I want to see how it runs. So that just gives you an idea of the thought process that I think you need as you go into these pricing decisions. We spend most of our time at this point, what are the tools we can do? So I want to look through corn today a little bit and then think, what would I do with corn I have today, with corn basis contracts I might have today, with calls I might have, or should I get a call, buy a call, and then I'll look at new crop. What are the fundamentals? What's the market offering me today? Does the market have any trends right now? Uptrends or downtrends? So here we go back to our favorite chart, and notice right here I labeled this old crop. I need to fix one up that will really do more. For example, you know, we went through the end of last time, and as I sent out kind of a new crop one, store cash or wait to price. You know, I mean, you can't store 2014 corn, but you can wait to price it. So those kind of things. So we've gone through our tools. So what do we have to decide here? We have to decide whether we think the basis is weakening or the same as weakening. If it isn't strengthening enough to pay storage, it might as well be weakening. Okay, I only like the basis later when it not only strengthens, but it strengthens more in my storage. Remember, we're doing old crop. We'll talk about new crop not very long. So we go through this. We have to make some decisions. Do we think futures are going up or futures are going down? We're going to look at that. Then we're going to calculate our pricing tools out. If a hedge works, then we know we're over here. If a hedge doesn't work, then we know we're over here. Now you say, well, there's only a hedge here. Just because a hedge works doesn't mean you hedge everything. Okay? You'd hedge. It depends on your pricing goals, what you think, where do you think the market's going. You'll store cash either way. You'll store cash under selling futures, which means you haven't locked in your basis, but you've locked in your futures. Or you store cash up here where you haven't locked in your futures till later or basis till later. We don't do it. We don't do it now. By calculating out the tools on that spreadsheet, we'll be able to determine which side we're on, and then we'll try and look at the fundamentals as whether we think futures are going to go up or down. Can things change? Obviously. The 213 crop is going to be heavily influenced by the 214 crop growing season. Not only here, but around the world. So let's look at it. Now, for a little bit, I want to look at this column right here. And don't look at this green or yellow, okay? This is where we are today. This is today's fundamentals, but this plays into it, okay? So we'll look at it, just the bottom line of it just a little bit. Last year we had about a trend yield, okay? If you look at a long-term trend and drew a line through it, one of these, you know, it nailed it, right on it. We didn't get all the acres planted we expected to. There was about 1.8 million that were not. And if some of you listened to that webinar, the Outlook talk, I talk about all these in detail. My outlook has not changed very much despite the fact that prices have gone up. So we came in with a record crop, just about 14 billion bushels, more than we've ever grown. The previous record was just a little bit over 13 billion bushels here. But we didn't bring very much in, so the supply was no bigger than 2009 here. So we have a lot of supply, but supply by itself doesn't give us the bottom line. How much of that we're going to use? If we're going to use all that up, then more the merrier. We have to look at use, livestock. As you see here, we're going to use a lot more feed this year than last year. But most of that is because we have a great big crop. Not that we'll be feeding a lot more livestock. And things that we fed, other things we fed last year, we'll be using corn again. We'll be using corn for this year. Given what I see of livestock numbers and my worry about PED virus in hogs, unfortunately, I think, that may lower that number. If we don't have hogs to feed, they're hard to feed. On the other hand, it's been a cold winter, and we're probably feeding more to cattle and especially those animals outside than we might typically feed them. The other place is it's still very dry in Oklahoma and Texas and that force. Now, they're cow herds, so they may have to supplement those herds. A couple years ago, corn prices were high, they had no grass, and they had to move the cows out. This year, they don't have enough grass, or not quite enough. They can supplement it with corn, which could help with that number. So a lot of flux in it. Ethanol, 5 billion gallons. That's where we were for a couple years. We're going to stabilize. Myself and the USDA going out further, that's probably about where we'll be. We may grow marginally. We have enough plants. Those plants are making money. The big deal really is the spread between the price of ethanol and the price of gasoline. It's about 70 cents right now. That's enough to make money, especially given most of the plants are paid for, or largely paid for. So we look at use. We're looking at record use here, domestic use. Then we look at exports. Exports have been very strong, or it doesn't look like we'll have a problem reaching this forecasted number. And that forecast has been going up. Let's see, it'll be on Monday, I think it is, the 10th or 11th, the USDA will come out with a new balance sheet here, with a new projection on 2/13/14, and they may or may not change exports. Right now, I'm not expecting a big thing, but they're moving right along. The key number is this ending stocks, and the ending stocks is part of the use. So we take use and subtract that off. You see, this is the most ending stocks we've had since 2009. And even in 2009, we knew this number here was growing. That's 11.1% of use. That regularly would bring prices in the low $4 range. The USDA is estimating it'll be a little higher than that, given that some of it was pre-priced. So 450. That's what the supply demand here says we ought to be at. Let's look and see if that's where we're at. So we look in here. We closed today at 475 and a quarter. We were down just a hair after being up pretty good yesterday, and we'll look at that in just a minute. So we take the basis off this late in the year, and that fundamental forecast looks pretty good. So the fundamentals right now aren't telling us a whole lot about whether prices are going to go up or down. The fundamentals are saying for old crop, they're about right. Maybe futures are a little bit high. So we look at, in my mind, so we look at that. Now, can things change here? Exports could drop off. We could feed more. Ethanol, we could make more or less. These numbers up here aren't liable to change. It's hard to make more corn from last year. Now, what else is this chart telling us? Because now we're not just looking at whether prices are going up or down. The market says that the prices will go up through here. My question is, will they go up enough to pay storage? And we're going to look at another way. We can do a hedge and that'll tell us, but we can just look at it too. 475 because we're into March. The 482, so that's basically just under 7 cents, or 3 to 3.5 cents a month the market's willing to pay us to store. So we immediately start thinking, after this marketing class, what's my cost of storage? Is it more than 3 cents? Is it less than 3 cents? Remember to include opportunity cost. I could be paying off a loan. If I don't pay off that loan, then I'm accruing interest on these bushels of corn sitting there, because those bushels of corn could have been used to pay off that loan or pay off part of the loan. For on-farm storage, our opportunity cost, the production loans haven't been real big, real high interest. I mean, they may be big. Some folks, you know, you put your money in, if your money's in the bank, is your only other alternative at, what is it, 1/4%? Maybe you can get 1% if you're going to leave it there, but a lot of that's going to have to be pulled out. So for on-farm, that probably covers it. For off-farm, the market's saying don't store it. Then from May to July, it's going to pay you only 4 cents. That was 6 cents just a couple weeks ago. Okay, the market's starting to tell us something. If we are storing corn, if we do have a hedge, we got to be watching. Should we lift that hedge that we had a while ago, or not? Because right now it's starting to look like it. By May, the story may be it's time to lift those hedges. Well, what's the chart telling us? Well, the first thing I want to talk about on this chart a little bit is go back to anchoring. Here futures were 610, 30-40 cent basis. We could have gotten 580, 570. Now that was before we harvested it. It was, you know, a year ago. We didn't harvest it till in here. Not much was, and I'm afraid that was due to this anchoring thing. And then we fell, about the time we were going to do some of that, and we did a little, it fell into this $5 range here, or where I mean, the prices, the futures were higher, but we could have locked in over $5 in cash. Again, well, it just been $6. We let that too big an influence. $5 cash corn's a good price for corn pretty much any time. Then the market dropped off. It came into harvest time. So here's where we've come recently. Since the low, you know, we've gained over 60, 70 cents. Now, a couple of those were big moves. You know, like yesterday. Today we're down at 1 1/4, but yesterday, well, we were up 10 cents or whatever, 8 to 10 cents. Okay. Is the market telling us something? Are we going to run into resistance? We broke through the first resistance. Okay. I think we've been in this long enough that we are now in an uptrend. Versus down here, I don't know what I'm in. Even right about here, I'm not sure whether I'm just going sideways or not. I think we'll hit some more resistance right in here. And then the next resistance will be here, and I think there'll be a ton of it at that. These prices are now, when you take the pretty tight basis off that, they're at or above what fundamentals would suggest. And given when we think about what next prices are, years, it's this price. If we start looking like a bigger and bigger crop, doesn't really matter just what this fundamentals are. Oh, I can use up a lot of that big ending stock, because I'm going to have a lot of corn next year. So the fundamentals saying, think about pricing. You're a little above fundamentals. Technicals are saying we're in an uptrend. We may want to ride some of that on corn we still have. Now, you may be in this July corn market two different ways. You may be storing corn, or you may have had a basis contract, because otherwise you're going to have to pay commercial storage, and you bought that back in here. Do I cash in that basis contract? What month's it on? Hopefully it was an out month, something like July, so we didn't have to keep rolling them. It might be when prices hit this low, and I'm going to talk about this. You know, when we say sell cash and buy futures, that's like a basis contract. What's neat about understanding that is we may have sold our cash back here, and we may not buy futures here. And as long as we're not buying more futures than our production, we're speculating no more than if we just stored the cash. Okay? And I'm also going to look at that again, the same thing for calls. So I think the market's saying you need to have some targets in there for your July corn. The market's still telling you to pay it. Okay? Let's say all of a sudden the market says I'm not going to pay you to store it again, and the market's still in an uptrend. Okay? Then you sell your cash, or you lift your hedge, and you go into a basis contract, or you buy futures. Okay? You could be in a hedge, you deliver that corn, and switch it over to basis contract, get out of the hedge. So there's multiple things you can do here with the tools we've learned. Maybe I want to buy a call just to ride this thing up. But if by the time we hear the planted intentions acreage report, which will be at the 30th or 31st this month, and it's a key day. That's another way you might use futures or put. Let's say the market rallies up and is in this area here. You can't afford it dropping when that report comes out, so maybe you buy a put. If the market drops, you're protected. If it doesn't drop, you just sell the put. So technically, we're getting near, we're in a position where we might be able to get some good prices, but only if we're watching that. And my guess is some of this needs to be done before the planting intentions report. What's our risk? We have a lot of risk right till July. Okay? Futures are in here right now. These were last week. They'd be adjusted up just a little bit, but the tails are about the same. There's only 1 out of 10 chance it could be under $4 this year's crop, but it's real. What could do that? We plant 94 or 5 million acres instead of 92 or 3, and it looks like we're getting 165 or 170 bushels an acre. That'll give us these prices this year yet. What could give us these? The opposite. We plant 92, we might have some prevented planting to lower that a little bit, or plan on planting 92. The weather doesn't look so good. We have, I shouldn't say this, hopefully we don't have, after this winter, a 92 or 3, whichever, 92 I think it was, where we had no summer. We don't need this winter extended any. But the point is, there's upside potential. Okay? We need to do something to prevent this happening, but maybe be able to take advantage of some of this. And we have different pricing tools that allow us to do that. So here we are. Here's the different charts. Let's go see what the market tells us. Right now, I would argue we're kind of a little bit in here. I'm going to test the futures going up a little more, but I'm going to be really careful that I don't stay in that mode when this happens. Let's see if basis is strengthening enough to pay storage. This is I stuck in here. It's what I just talked about. You can buy a put or sell futures, otherwise get a hedge. That decision can come after your initial store or wait the price. Okay? It may have been that I just stored it. I thought prices were as high as it could be, so I sell futures. Then I have a hedge. I stored it. I'm worried about prices going down. It might be right now. Maybe I buy a put, protect downside risk, but I'm going to keep storing my corn, on-farm corn. Or you could buy a call or futures afterwards. If we look at this chart here, once we had this day here, once we got past here, buying a call at this point, once we got this point here, buying a call at this wouldn't have been a terrible idea, or getting back in on the futures. Again, you have to know what kind of risk you can take. Here's the chart. It's only the top half the chart because that's the only part that matters right now. Okay? These different ones, I jumped around the state. This was a place where there's pretty good prices right now. I might have been down towards Blissfield. I forgot to change the date here. I apologize. So I was given these were PowerPoints. I stuck the date up here. The current price 455. The futures were 486 today and a quarter. In this particular area, I'm expecting the basis to be about 5 cents. About 8 months, about 8 cents of storage. So the hedge is 472. That's better than today. Okay, so it says the market is. Now, if I was on farm, I would have had to add, commercial, I would have had to add probably another 16, 18 cents to that. Okay, the difference between this and this is what? 17 cents. Okay, so if you have corn in commercial storage right now, the market's telling you you should not be paying to store corn, period. The other alternative is a forward contract. They're offering an 8-cent basis. My 5 cents has a risk around it, so you could lock in 470. Given I think there could be a lot of basis risk going into the summer, if I decided I like this price, it's worth it afterwards because I'm to do a forward contract if I have on-farm storage. This is for June delivery, and get 470. Okay, now yes, no, it's not there, okay. 470, the forward contract, but that's one of those things that you always compare. So if I think prices are going down, or I don't want to take the risk of them, now that the market's made a pretty good upswing, I'm going to do a hedge or a hedge to arrive, or I'm going to forward contract. If I had a lot of corn left, I would really consider this, especially if we have another little bounce, but maybe even without it. Let's say I want to keep more upside potential. If I take one of these put options here, I'm just a little bit, if I had a good yield this year, I'm only a little bit under my cost of production. Not that the market cares, but when we're thinking about how much money do I need to keep my net worth going down, these numbers could probably do it for any farmer that had a normal or above, especially if they had above average yield. This could give us that, and it gives us upside potential. They're not a whole lot better than these. They are a little bit. They're hard to compare a little bit because I choose out of the money puts under futures and these would cost a little less. The reason these don't look too bad, especially the forward contract one, is the same reason that the forward contract net return is not very much different than the hedge. So if you think this is a good pricing alternative, give those, or you're getting close to it, and I had a lot of corn left. If I don't have very much corn unpriced, or I'm in a really good financial position, I had a really good yield, I've already sold 90% of my expected production, I still have 30% of my production left, I can take more risk. And then it's whether you want to or not, and to be careful. So again, how do we do it here? Now, I don't have the bottom of this chart because we don't know what happened. The decisions have to be made at this point here. Then we look at new crop, and of course new crop does others, and I have the forecast that I put in the Michigan Farmer for the February 15th issues. You need to check the years at the top. The numbers are right, but in the third column, unfortunately it says this, and it's actually this one. And the USDA came out with their estimate on the 21st. And we really don't have a lot of new information since then, other than maybe in the Ukraine, although it's looking a little less like it. If there is trouble, they grow a lot of corn, and so does that part of Russia. On the other hand, they both really like money, so I'm not sure a whole lot will happen there. Two different stories. The biggest difference in this story is the USDA is looking at a lot higher trend yield than I am. So because of that, even though our acres are less, I have a huge supply, a record supply. They have a lot bigger record supply. Their numbers are reasonable. This can happen. Now, I could handle a trend yield about 162. I struggle with this one. They do have a written up document where they get there. I think feed use will be about the same because this year I don't think will be quite that high. We'll be holding back a lot of cattle. We won't be through this hog thing yet. The USDA is a little bit more, and the crop's not, well, their crop's is big, so that's one reason they'd be feeding more. My crop's a little smaller, that means we generally feed a little less. Ethanol, we're really in the same ballpark. Exports, given our exports today, given we had record yields of corn a lot of places in the world, given Brazil may even go a little bit more towards it, I'm a little bit more optimistic on exports than theirs. Now you need to remember on these numbers here, when they're over here, they have NASS numbers, they have surveys, they have a lot of things. Over here, and they're actually, I consider them very good analysts, they're kind of just like I am with maybe a little more information at their fingertips, but we're both sticking our necks out there pretty far. Now when I have more use, they have a little bit, their ending stocks are huge. I say 12.2 gives us 380, 385, 390. I would say if I didn't see this number here and I saw this 15.8, I'd put this at $3.35. If we have this scenario, I think we'd be touching $3 at harvest time, or we might be. Okay, so this is where the fundamentals put us. Now, this is my fundamentals and the USDA's fundamental. Okay. The market has a lot of people looking at fundamentals. So we look here, the market's saying 483. You take 50, 60 cent off of that and they're saying 430. Okay, and we'll look at the actual ones. A little bit of this, when we decide to price new crop and we have, say, on-farm storage, I like to make my pricing decisions based on December. But the market's telling me that over those 3 months, I'm going to pay you 6 cents, from 3 to 9, right? That's only 2 cents a month. So I'm going to stick with, if I do a hedge to arrive, I'm going to use December futures at this point. If the market's telling me to store it when I get there, I'll roll my hedge, which is something we didn't cover. But basically, you buy back the December hedge and you roll it into next month. Then they go back to paying about 3 cents a month, and then a little bit less. These numbers don't really become very clear with respect to should I store or not. So that's why I like to make the decision of do I think it's a good price or not right here. If they are paying me a ton to store, then I'll go ahead and price it new crop in March for on-farm instead. So right now, the market's saying, Hilker and USDA, you're wrong on your fundamentals. Or it's saying, we're way higher in fundamentals, you better think about this. We had chances early. This chart looks the same other than lower. We got down here in the 440 range, which meant you take 50 cents off of that. The new crop offers for next year dipped under $4. Not quite down to our estimates. The market also tends to be paying a premium, as I mentioned earlier, but this is a big premium. 483. Oh, good question. I was going to talk about that. Ned says, how'd you come up with a price probability chart? And as I hit this next one, I'll explain that with the numbers in front of me. Thank you, Ned. I said I'd do it earlier, and I didn't. The market's up here, 483. We've had a nice run. We are in an uptrend. Watch out. Part of this was big moves over something that may not turn out. And let's look and see what the market's offering us compared to the fundamentals. But we are in an uptrend. We don't have to get too excited, but we need to get kind of excited. And if you haven't priced any, I might get a little bit more than excited, but all I can tell you is you ought to consider stuff. I don't tell you what to do. Here's this probability chart, and where do we come up with these? Okay. I calculate these from the options market. There's a formula out there that an insurance agent, basically, and this has been changed just a little bit, or an insurance underwriter would say there's so many car accidents in the Lansing area. This is going to be our cost to us, given that number of accidents, which they look at historically, usually what's been happening, and then they also look at some things like the risk of people being able to pay or not. What does the premium have to be? The options markets bid a premium. So I take a formula, not a whole lot different than that insurance formula. I assume I know the premium instead of the risk, and I use the same formula, but I solve for the risk instead of using the risk to solve for the premium. Okay? So I know the premium the market's insistent on to insure the price. And this December, this was about it wasn't 486, it was about 468 when this chart was done. But at this point, you can move along it just fine. And this is the risk that the market is. That premium would pay for this type of risk. Now, this is the one I scribbled up a lot last time, so I redid it. Remember over here, I had store. Well, if it's a new crop, we can't store it, wait the price. Same idea. We're going to wait to fix the futures till later. We're going to wait to fix the basis till later. Instead of store cash, buy a put, we're going to wait the price, but we can still buy a put. Okay? Minimum price hedge to arrive is the elevator doing that. Over here I have a basis contract to go, but that basis contract, remember, is calculated between the futures and the forward contract they're offering. So if I want to duplicate that, I could forward contract and buy futures. Or what's kind of neat about this is maybe I could forward contract right now, remember that, and buy futures later. Or forward contract and buy a call, which would be a minimum price contract. So there's a few less alternatives because we can't store it. But the concepts, I haven't changed the concept here at all. I've just changed the wording. I could have put store or wait the price. Store or wait the price. The problem is I ran out of room and haven't figured out how to make it look pretty. Some things here are already pretty small. So what we want to look for is what's the basis. Now, basis strengthening here, weakening. We don't have a cash price today, so remember what this is. Okay? This basis here is the basis that they're offering you on a forward contract today. And we'll look at that. This is the basis you expect it to be. This is the basis they're offering on a forward contract. This is what you think the basis will be at harvest time in this case. And the same in these ones down here. So instead of what the basis is compared to some futures month, whatever one you pick in today's cash price, it's the futures month you're looking at, in this case usually December, or for soybeans, November. So we do it. I put the production cost in there at 450. That matches up with pretty close to this 458 maintained net worth. Futures closed at 483. They were offering a 25-cent basis. At this particular location, I was thinking about 20 cents. Remember, on new crop, there's a lot more basis risk at harvest time than there is, say, at the other times. And it could be a lot worse. So the elevator's offering a very competitive basis here. I could forward contract for 458. In this case, over this my net worth. But you know, your costs are going to be different, so you need to put your number in there, not an average number. The hedge is a little higher than the forward contract, so maybe if I like this price, maybe I'm going to split things some. If I'm going to forward price 20% of my crop, I might do 10% of the forward contract and 10% in the hedge to arrive. The hedge to arrive also gives me more flexibility. I can get out of it. Let's say the price drops really low. I may buy that futures back and speculate again. It's called selective hedging. I didn't teach that. But it's hard to do these days. I'm not really suggesting it. Back when we had the loan rate, anytime we went under a loan rate, you'd suggest it. We look at the strike prices. We can lock in a price that's lower than our cost of production. But when we look at the odds here, think about that 419 might get us past cash flow, not quite. But maybe I divide what I want to afford into 3. 5,000 bushels, 5,000 bushels, 5,000 bushels. This one, you average them up, I'm near my cost, and this one gives me upside potential. It doesn't really matter much in this case whether you do the hedge to or put, or whether you forward contract and buy a call. Or in other words, we're very close to that center point where we weren't real sure where the basis were going to strengthen or weaken. Let's look at the same thing on soybeans now that you all know what to do with corn. We planted a few less acres than we thought. This yield was actually a little bit below trend. We brought almost no soybeans into this year. So our supply was pretty big, but it was big because of a lot of acres. Last year we had more acres, but we had a poor yield. We'd had a poor yield for a bit. Believe it or not, the record yield is only 44 bushels an acre. So we come through here, we had a pretty big supply compared to the last few years, but we've had lots of years where we had about as big a supply. Crushings are going along pretty good. Exports of them aren't too bad. Exports are going really strong. Right now we've actually agreed to deliver almost 1,600 or 1.6 billion versus 1.15 billion. Some of those will be bought back, but I wouldn't be surprised if soybeans are going to stay tight this year. That doesn't mean price will stay high, but U.S. stocks will stay tight. Because if let's say we had to do them all, that'd be another 80 million. You'd take that off of there and we'd have almost no ending stocks. Big use, even though we had a pretty decent supply, very little ending stocks, very tight market. Why is it lower? It's lower because Brazil is having a record crop. Argentina's having a record crop, not quite as big a record crop as they were hoping for, but things have improved recently. So it does look like they'll meet this last time here. So the market says about 1270. Now, that 1270 is taken into account that we think price will fall off as people move to it. So 1270 is probably a little bit low estimate, given this tight of ending stocks. So let's look and see where we are. So let's may even say this is 1320 or 1325. Okay, the market is at 1420. As we've talked about, March is going to run out here pretty soon, so we'll look at May 1420, about the same. Won't pay any storage for the next 2 months, so the market's saying don't pay storage. We've talked about that quite a bit. You'll pay an extra 25 cents to go into July and then another 50 cents to store it in August. We found out, though, the market's been saying this since harvest. Okay? Whether you should store or not, remember, I can't say it enough times, is not the same of whether you want the futures are going up or down. Okay? Any one of these futures months is going up or down. So right now, the market's above what fundamentals would suggest. That's mostly based off of the large South American crop. We're tight, and we're going to stay tight here. We look at soybeans. Okay. These were good prices. You could lock in almost $13 cash. $13 cash is a good price, like $5 corn. Are we better now? Yes, that's okay that we're better. Okay. That other 1270 is we've sold a lot of soybeans when prices were a little bit lower. We're in an uptrend. No doubt we're in an uptrend. You heard me say earlier, don't fight a trend. On the other hand, if that trend changes, don't fight that one either. Okay? One, the market's above what I think fundamentals are. The tech says it could keep going. There's really no upside lit on this market, although this one day it shot up high. There's probably a little bit of resistance at that point. Think about it. Is that a good price? How does that match up with your cost of production? How does that match up with the amount of risk you want to take? Now, a lot of us probably are out of soybeans. Okay? Should I get out? Others of us may have been in a basis contract, so they have a different decision. Okay, this was a double bottom. When we got to about here, we had not only an uptrend, but we had a double bottom saying that we probably were at our low without some change in the fundamentals, the supply and demand. We've had a good run. Should we use it? Again, the technicals are saying we're in that uptrend if we have some left to price. But I don't think I'd be buying futures or a call right there. What are the odds? The odds are the prices could drop quite a bit. What happens? We start having a big crop. So what if we're tight on September 1? If we're going to have a whole mess of beans on October 1? We don't have any stocks coming in. If we start having a poor yield, we don't get the acres planted that I'm talking about, that's going to affect us. And when we look at new crop here in just a second, we'll see that. Old crop, where are we? That's what we're looking at this chart. So let's go look. Okay. July futures are $13.95. The current cash price at this market was $14.20. This is white pigeon. I don't know if we have anywhere. I think, yeah. The reason I did that is I was having a hard time finding a forward contract quote, and Anderson's a white pigeon had one, $13.75. Now, excuse me. Do you want a forward contract at $13.95 or sell it today at $14.20? Especially after paying, and this is kind of on farm, lost interest. If it's at an elevator, you can double that or more. $13.75. I think I'd rather have $14.20. Let's look at the hedge. I'm even saying a real tight basis. Now, regular basis is a little under zero there, but this particular year I don't expect it to be. And as you see right now, they're offering a zero basis. So we have no reason to think the base is going to strengthen, and therefore our hedge isn't even as good as a forward contract and is worse. So the market's saying, we're over here, folks. The basis is saying we're over here for new crop. I mean, it's a new crop, but no, this is the old crop, but I'm sorry. Yeah, the basis is saying we're over here. So we got to decide are futures going down or futures going up. We talked about that. There's some reasons why it could go down. Right now it's going up. The question becomes, how far is it going to go up? Or is it done going up? You know, as soon as it's done going up, you fall right back to here. Not that the price has fallen, but it's not going up anymore. The puts don't look very good, just like the hedge doesn't. If we wanted to get in it, I would take today's price if I wanted to stay in the market a little bit. Maybe I'd buy a call. This one's just barely out of the money. Maybe if I'm worried about prices going way up, I might go and get a 1460 call and cut this price in half. Would it help me if prices only go up a little bit? The answer is no. But if prices went up into that $15 region that we saw, or that $14 or $15 region, excuse me, the $15 region, then that would start paying off. So the market says price is good today. We got to follow those fundamentals. Now we come over here next year. The USDA has planting a little more soybeans than I do, and I'm leaning towards their number. My problem was planting 78.5 got my price low enough. The long-term trend, which would be a record's 43. Again, I think they're a little high, but we could get 45. These numbers aren't a whole lot different. They have a little bit bigger production. The use numbers, they're a little bit more optimistic than I am. I think with another huge South American crop, I'm worried about it. We're having some trouble with diseases of livestock in China right now, and they import an awful lot. But they have more use. But even with their more use than mine, we both have huge ending stocks. Okay? I say 7% gives us prices under $10. So do they. I would argue if we have 285, we're probably closer to 940. Okay? So the fundamentals are with this type of acres, okay, so use mine, just because mine's better, 960. Let's see what the market's saying. Well, as we found out, we had a decent crop this year. November's fell off. It hit a low in late January. We're definitely in an uptrend, but you see it's pretty shaky. Prices closed at 1180, 1179 3/4. We're in an uptrend. Don't like to fight the trend. But we need to really be careful here about a change in direction. Here's our probability distribution. You got to tack about a 50 to 70 cent basis on these. The market thinks this is where I'm a believer in the market. So the fact that my estimates don't match up to the market worries me. Okay? Because we got to deal in the real market. But I do think the numbers I showed you say there's downside risk. There's really downside risk. So let's look at that with these. If we did it today, the market I was looking at was offering 1050. Or excuse me, those production costs at 1050. I made them a little higher than this 1097 here, or 1017, the middle one. Sort of split the difference. Again, they need to be yours. Futures closed at 1180. This location, they were offering a pretty good base at 50 cents. I think it might be a little better. A forward contract, and this is pretty good. Now, I can lock in about 1130, whether I do it this way or this way. I'd argue that's almost $2 higher than what the USDA scenario would give you, and about $1.50 higher than mine. Does that mean prices can't go up? Absolutely not. The last 2 weeks of prices going up would not have been predicted by the fundamentals in the market. Now, where could our fundamentals be wrong? There's a lot of buying goes on. Maybe exports, they're already buying for next year. But some of this is the market was scared a little bit. The market's also trying to buy soybean acres. They want to make sure we have those 78 or 79 or 79.5 million acres planted. These are kind of interesting. These levels here are higher than your net worth calculations. With a put, are they expensive? Yes. You could even buy a cheaper one and lower your protection a little bit, go down to a 30 or 40 cent one and lower your protection to maybe 10, 20, which for on average would keep people at not losing their net worth, keep their net worth. Although we do, of course, have the yield side of this thing too. So some combination of these tools might be reasonable. Again, the fundamentals are saying the price is high. They're saying a lot of risk. But the technicals are saying, let's be careful. Let's see if the market has a little bit in it. We're going to have a lot of resistance right in here, but if we break through that resistance, we may have some pricing opportunities up in this area despite my fundamentals. We looked at these. We have a chance. We're real close to having a chance to lock in total economics cost. If we do that, to me, that's a pretty good point. So where are we right now? For on-farm people who might be doing it on, basically we're right here kind of in the middle, and we're more concerned about prices going up and prices going down. The elevators I've seen are offering very competitive basis compared to what we think they'll be. So there might not be any reason for us to take a lot of basis risk. So again, our concern is up or down. If I might be wanting to store some of those at harvest, then I might want to do a hedge to arrive versus having to deliver at harvest time because I may want to roll those beans. So the reason maybe to be a little bit more on this side on new crop is if you have the on-farm storage for some of your beans, and it might be that the market decides that it would pay for them and you want to leave that opportunity open. So that's where we're kind of going. I think there's good pricing opportunities on both old and new crop corn and soybeans, especially if you have a lot of old crop left on one or the other or both, or if you have not priced too much new crop. Again, don't get caught like we did in 2006 where we probably overpriced. But if you priced 20% at these type of prices and they went up another 50 cents, at least these prices are still decent, very near, if not at your cost of production, or at least not your full economic cost, but ones that will keep your net worth. And there is considerable downside risk. We could have 170 bushel an acre of corn. We could go under $4. Most likely? No, absolutely not. Are you prepared for it? That's the key. Some things we haven't covered. We haven't covered rolling hedges, but I just talked about them here. It can be a pretty important tool. One thing is, one nicer thing about a hedge and a forward contract, if you've hedged at a good price and you've done it yourself with your own broker, and it's a good price, and you don't have the production to cover it because you had to use it for some of the other, you can roll that hedge till the next year. Okay? You may not lock in as good a price, but at some point, as soon as you know your yield's down, and it happens most years, it did not happen in 95, 96, but actually if you'd waited into fall, you could have. If you hadn't rolled it into July 1st, which an awful lot of them did. So this is a good tool. There's a fence, or called mini-max, with the basis open. That's when you're on the side of the right-hand side of the chart. I don't have them on this one. I have another chart that I'll put up on the website that has those in it. Store cash or wait to price. And then you buy a put just out of the money like a put we did, but they're expensive. So I sell a call 40, 50, 60 cents higher. Okay? They pay me for it, and I use that. Now remember, we didn't sell calls here. That's like the insurance agent. We sell that call to help pay for the put. Now what's a put? A put's the right to hedge. Okay, so we have, that's on the downside. If we sell a call and someone calls us on it, they get a buy, we get a sell. What's a sell in the futures? It's a hedge. So as long as you have the production, you get a sell in the futures, and basically you have a hedge. At that call, that was 40 or 50 cents higher than prices are right now. Okay, or at least 20 or 30, depending on how much money you wanted out of it. Okay, that gives you a range. It gives you a downside that's higher than just a put, but the cost of that is you take away the upside. Then you can do the same thing where you sell cash. You buy a call just in the money, just under futures, and then you sell a call out of the money to help pay for this. Okay? On the downside, you've sold it, so that works fine. Again, on the upside, it's like having a hedge on the top, just like I said up here. But if you start losing on this call, you have this call to pay for it. Here you had the cash crop to pay for it. If this one starts going, you have this right to buy to pay for this one at some point. That's pretty much the end of the marketing workshop. I'd like to remind you it was sponsored by Michigan State University Extension, in the sense that it pays a lot of our salaries here. So that's the main. And Michigan Corn, made up of the Corn Growers Association and the Checkoff program, paid for all the taping and so forth, and it's much appreciated. And I'd also like to thank Dennis Stein and Ned Berkey and our people up in Gratiot. Was it Paul Wagner up top? So we got Dan up in Gratiot County, and some other people working there too. So I'd like to thank them all for all their helps. We don't have to do this right now. Everything will be left up on the web page, which I have. Questions, feedbacks, next step. I hear a person with any plans to do more an advanced online class. No, but my job's teaching, so it's a possibility. If I did do one, I'd probably spend a little more time on a marketing plan, risk type things, and these are the type of things that I would cover. It could be done in much less time. The other thing you could do in advanced classes, if people are, and I would do this a separate one in these tools, where people are interested in just learn a little more about fundamentals or technical analysis. Email me. I'm an extension economist. I'm an extension marketing specialist. If you have questions about this material 5 to 10 years from now, call me, email me, ask me. That's my job, to help you with this. So these questions aren't just questions that we've learned here. If they're questions on marketing anytime in the future, as long as I'm still here, which I hope to be for quite a while. Feedback on this program, improvements, next steps, those type of things. Net as a thing. There are other things out there at other universities. CME has a video you can look. We just talked about next steps, and again, everything will be left on the website. This website here with my email. This website here looks a little different, but it will take you right to the marketing portion of that firm website. But again, I'd strongly urge you to check that out. I'd like to thank all who participated, whether it be live right now. We have about 25 people hooked up, and that includes 3 groups. And there was over 100 people registered. So we'll let them know. The other thing we want you to know, and I put the dates up 6 times a year, Dennis and I are going to be doing an Outlook webinar where I also tell you what tools I think you ought to be using. I put those up on my web page, and I always put the date of the next one. It's in April. It's always the last Tuesday of the month, every other month, is what it is.